The third learning objective is to account for the sale of inventory using a perpetual system. After a company buys inventory, the next step is to sell the goods. The amount a business earns from selling merchandise inventory is called sales revenue, often abbreviated as just sales. A sale also creates an expense, which is cost of goods sold. As the seller gives up the asset, inventory, cost of goods sold is the cost of inventory that has been sold to the customers. Cost of goods sold, often abbreviated as cost of sales, is the merchandiser's major expense. To record sales of merchandise, two entries are needed. The first records the sales revenue. If the sale is on account, accounts receivable is debited. If it is cash, cash is debited. In either case, sales revenue is credited. The second entry records the cost of merchandise by selling the cost of goods sold. You're going to debit cost of goods sold. Since inventory is leaving the company, the inventory account is credited. After making a sale on account, a company may experience a sales return where a customer returns good or refuses services, or a sales allowance where the company may grant a sales allowance to entice the customer to accept non-standard goods. This allowance will reduce the cash to be collected from the customer. Both sales returns and allowances are debited to one account. This account is a contra revenue account with a normal debit balance. If a customer returns an item or is granted an allowance, sales returns and allowances is debited. The customer's accounts receivable is reduced. If the transaction is a sales return, that is, the merchandise is physically returned to the company, a second entry is needed. The inventory account is debited and the cost of goods sold is credited. If the transaction is a sales allowance, only the first entry is needed. With a sales discount, if the company pays within the discount period under the terms such as 210 net 30, the seller collects the discounted amount. If a company offers discount items and the customer pays within the discount period, sales discount is debited for the amount of the discount. Accounts receivable is credited for the full customer balance, less any returns. Cash is debited for the actual amount received, the difference between the receivable and the discount. Companies maintain separate accounts for sales discounts and sales returns and allowances, so they can track these items separately. Net sales revenue is calculated as sales made to customers minus sales returned by customers or allowances granted to customers minus discounts given to customers who paid early, that equals net sales. Notice that all selling transactions utilize accounts beginning with S, such as sales revenue, sales return, and sales discounts. Net sales, cost of goods sold, and gross profit are key elements of profitability. Net sales revenue minus cost of goods sold is called gross profit or gross margin. You could also think of gross profit as the markup on the inventory. It is the extra amount the company received from the customer over what the company paid to the vendor. The gross profit must cover the company's operating expenses for the company to survive. Gross profit, along with net income, is a measure of business success. A sufficiently high gross profit is vital to a merchandiser. Short exercise 5-6 is an example of journalizing sales transactions in a perpetual inventory system. Suppose Prana.com sells 2,500 books on account for $15 each. The cost of these books is $22,500 on October 10th, 2012. 100 of these books, which is the cost, $900, were damaged in shipments. So Piranha.com later received the damaged goods as sales returns on October 13th, 2012. When the customer paid the balance on October 22nd, credit terms were offered to the customer were $215 net $60. So, journalize the transactions. Recall that Piranha.com sells 2,500 books on account for $15 each. The cost is $22,500. Accounts receivable is debit for $37,500, and sales revenue is credited for $37,500. That's taking the $2,500 books times $15 each. To journalize the cost of goods sold is debited for $22,500 and inventory is credited for $22,500. That's for the cost of the books. Please remember that 100 of these books were returned at a cost of $900. They were damaged in shipment. The first entry, sales returns and allowances, are $1,500, and accounts receivable for $1,500. The cost of the return is a debit to inventory for $900 and a credit to cost of goods sold for $900. The exercise continues on this slide. The customer paid the balance with credit terms of $215 net $60. Cash would be a debit for $35,280. Sales discount debit for $720. Accounts receivable credit for $36,000. Short exercise 5-7 reviews how to calculate sales and gross profit in a perpetual inventory system. Gross revenue, $37,500, less the sales return of $1,500, less the sales discount of $720, gives us net sales revenue of $35,280. Gross profit is net sales, $35,280, less cost of goods sold, which is $21,600. That gives a gross profit of $13,680.